What's up, guys? It's Michael Key, and we're going to get right into it today. I'm going to drop a little perspective on you. I don't think a lot of people really look at options like this, but the key to really maximizing options, in my opinion, is to learn the beginning and the end result. The great thing about options trading is that you can actually do trades where you know what the end result is going to be. And when I say that, I mean this. I'm always telling people that the end result is always to own the actual underlying asset. Why? Because then you can hold it for long periods of time. You don't have to worry about time decay, and you're owning the asset. An option is not an asset. An option is a way to either leverage the underlying asset or to utilize what's going to happen in the future to your advantage. So there's two ways to utilize options to enter into the underlying asset, and that is to sell puts or buy calls. When you sell a put option, you're going to pick a price. It's basically like setting a buy limit order, but you're getting paid because you keep the premium. So if you were going to buy an asset, let's say you were going to buy Apple and it's at $105 a share and you wanted to buy it at $100, you would sell a put option for $100 a share with that strike price expiring in whatever day in the future. And let's say you collected a $200 premium. You keep the $200 premium. If it goes down below $100, you let it expire, and you would purchase the shares at $100 a share, minus the $200 premium. So really your cost basis would be $98 a share after that. If you buy a call, let's say you think that Apple is going to go up. You don't want to put the money in it right now. So you're going to buy a call option for, if it's trading at $100, let's say you buy a 110 call option. You pay $300 for that call option. If Apple goes up above 110, you get to buy the shares at $110 a share. So that's how you could utilize options to enter into the underlying position. But what if I said we could use someone else's money to basically reverse finance shares to us? And I don't think a lot of people think of it like this. In fact, I know a lot of people don't think of it like this, but I want to just give you a perspective. All right, so when the bank gives you a loan, what do? They front you the money up front. So you're going to take out a $10,000 loan. They give you $10,000 up front to make you pay back in interest. So in the end, they're going to have made their $10,000 back plus all the interest you paid them. Why aren't you utilizing that same concept inside of your portfolio? If we bought an asset that we wanted to own for a long period of time, it could be a company, it could be an ETF, whatever, and we were going to buy 100 shares of that asset, if you go ahead and you buy it today, let's say it's $100 a share, XYZ, it's trading at $100. So we buy this would cost us $10,000 today. Bam. We put that's our money up front. Why not utilize opportunities that is going to allow us to either A, get our cash out of this position without having to get rid of the shares, the 100 shares, or build a position with someone else's money. Let's add more shares using someone else's money. Here's what people need to understand. When you sell an option, someone's buying the option. There's a winner and a loser on the trade. The winner is either the person buying it or the person selling it. More often than not, it's the person selling the option. Yeah, you have a limited upside when you're collecting a premium, but your chances of being profitable are much higher than someone who's buying it. So if we own the underlying asset, we can actually utilize strategies that take the risk of selling premium out of the equation. One is being covered calls. If we were to sell a covered call, we bought it at $100 and we were going to sell a 105 call. And we collected $300 for this. You can do two things. You put this in cash. If the stock goes up to $105, that's a $500 gain plus our premium. We would plus $800 in gains. It's simple. So we give ourselves a little bit of upside. Yeah, we cap our upside. Okay, that's fine. But the other thing is, too, is that if we bought it at $100 and we got a $300 premium, we're reducing our cost basis in the trade. So this $10,000 trade we had is now reduced by that premium. So now it's a $9,700 cost basis. Now imagine doing this over time, and we keep reducing our overall cost basis in that trade by collecting this premium. The other thing we can do is take this and reinvest it. So when I say let's utilize someone else's money, let's take this premium and let's reinvest it in shares. So when I'm talking about reinvesting the money back in shares, let's go over the same scenario. We sell the 105 call, and let's say we collected $300 in premium. Well, we have $10,000 up front, but if it trades at $100, as soon as we sell this, we would turn around immediately, because you get the cash immediately, and we would buy 3 shares immediately. That gives us a 103 share position now. If the stock goes up to 105, only 100 of these shares are going to get called away. So we still have 3 shares that are making gains for us. 3 shares that we use someone else's money to buy. That's the way I think of it, and that's the way I think more people should actually look at this. So if it's a stock or an ETF that you are wanting to hold long term, it's no different than doing a dividend reinvestment. In fact, it would actually work out a little bit better if the stock paid a dividend, because the most shares you're going to have called away when you're selling one call is 100 shares. You're still going to receive the dividend if you hold it past the ex-dividend date. So if it's paying, let's say, a 4% dividend, you're going to get whatever that quarterly dividend is, or monthly dividend, however it's paying, plus the premium. So you're maximizing the dividends you're getting, and you're reinvesting and you're using it to purchase shares. You're reverse financing this position. You can actually, if you do this sustainably for a long period of time, you can actually either pay yourself back out of that $10,000 or a big portion of that, or you could build on top of your initial investment utilizing someone else's money. So that's one way to go about it. The other way is to do this with put options, and I'll do an example on that. So if we're going to do this by selling puts, if the stock's trading at $100 a share and we want to buy 100 shares, let's say we want to buy it at 90. So we'd sell the 90 put. Let's say we collected a $100 premium. $100. If it's a cash secured put, here's what you can expect. You would put up to $9,000 in collateral. You still receive this $100 in premium. Let's take that $100. Let's buy 1 share. It doesn't seem like a lot, but this stuff adds up. Because when you sell the put, the cash secured put, here's what you know. You know that if you let it expire, you're going to purchase the shares at $90 a share. If you do that on a position that you're okay, in your mind, you're like, that's what I want to buy it at. It's a 10% drop on where the stock's at now. If it goes down lower to 85, yeah, you're out, but it's better than buying the shares at the price it was today. So you're buying it 10% lower than what it is today, and then you use someone else's money to buy another share on top of that. So you're getting 101 shares out of it. So you have a little bit more on the upside. And you can actually utilize this if you were selling call options, and let's say, your shares get called away because the stock went in the money, then start selling puts after your shares got called away to re-enter into the position. Let's say in my example of, doing the covered calls at the 105 strike, your shares get called away at 105, then start selling the $100 puts. You'd be entering back into what you bought the stock at anyway, originally, and you'd be getting a premium. And if it expires worthless, you take that premium, you buy more shares. You can do whatever you want with this premium. If you're using cash secured puts or covered calls, you're going to get this cash. You're going to see that reduction. You're going to see that cash added to your account immediately. Take it and buy the shares. It's not adding any risk. The only risk it's adding is that 1 share worth of risk that you're buying in this situation, or in the other one I showed you, the 3 shares worth of risk. Which on like a $10 move, 3 shares is a $30 more in risk. But it's money that you didn't have before, and you're buying shares with someone else's money. You don't care what it expires at, because you know the beginning and the end goal. It's pretty simple. You just got to be more cut and dry. I think people make this stuff a lot more complicated than it is, but when you utilize options for what they're meant to be used for, there's a lot of good that can come from it. It can reduce risk. You can, I call it reverse financing, because you're using someone else's money to either pay yourself back out of that position. Because imagine even if you didn't buy this share, when you sold the put, you got $100. It expires worthless. Well, the next time you go to sell a cash secured put, you have $100 more that you can put up for collateral. Money that you didn't have before. That was someone else's money that was stupid about that put that expired worthless. So these are just things to think about when you're trying to determine what option strategy you want to use. The other thing you can do too, and this would be my last example, is you can actually, this is called a collar. It's pretty common practice. If you own the shares, so let's say you have 100 shares, and if you have gains, or you may not have any gains, but you think the market's going to turn down, you can sell a call. Oh, my handwriting. You'd sell a call and use the premium to buy put option. What does that do? Buying the put hedges your 100 shares. On the downside, it's basically like putting a sell limit order in that is protecting you on the downside, and you're using call options, selling call options against your 100 shares to finance that hedge. The problem is people look at it like, oh, but I'm capping myself on the upside. We don't know what the hell is going to happen on the upside. You don't know what's going to happen in the future. So there's the big unknown with this whole thing is what's going to happen. What am I missing out on? What could have been? Well, you don't know, but when you're utilizing a strategy like this, you now have set parameters that you do know will happen. You know that either A, it's going to go above the strike price I sold the call at, and my shares are going to get called away, and this is my max profit on it. Or it's going to go down, and I've reduced my risk by the amount I sold the premium for. But people don't think of it like that. People look at it like, oh, what could have been? They want to hit a home run. It's not about hitting a home run. It's about being efficient. It's about using the least amount of money to get the most amount of gains. That's why people buy out of the money call options. So, high probability trades, let's use someone else's money to either protect our positions, grow our positions, or pay ourselves out of the positions without having to give up the actual underlying asset. If you have any questions, you can email me. I thought this would be a pretty cool perspective to give people. Let me know your thoughts. If you like the video, hit like, and don't forget to subscribe. Thank you.